Howdy, folks. Welcome to Liberty Call. Today is Thursday, March 7th, 2024. Hope you're having a good day out there. You can see my boy Jake back here. He is excited again for more financial news. He can't help himself. That's why he's sleeping. Anyways, all right. Well, like I said, hope you're having a good day out there. It is kind of gloomy here in Colorado. We're expecting a little bit of snow and a bunch of ice. So, for the next, 24 to 36 hours, I'm going to be hunkered down here at the house and no plans to go anywhere, which, again, makes my boy Jake back here sad because he likes to go outside and play. And I don't have a nice fur coat like he does. So, all right. Well, if it is your first time watching Liberty Call, if you could do me a favor, if you could give me some thumbs up, a like, a share, subscribe, a follow, and press that notification bell. Let's go ahead and jump into the markets for today. It's kind of mixed globally. Starting out here domestically, the Dow Jones was up 0.34%, 130 points, closed at 38,791. The S&P 500 up 1.02%. Closed at 51.56. NASDAQ up 1.51%, closed at 16,273. The VIX was down 0.41% today. It's at 1444. Canada up 0.93. Brazil down 0.41. And Mexico down 0.4. In Europe, Germany was up 0.14%. The UK was up 0.17%. France was up 0.77%. The Netherlands up 1.37%. Spain up 1.2%. Italy up 0.16%. Switzerland up 0.25%. And Portugal up, down 0.18%. Russian exchanges, both green, barely today. The MOEX up 0.09. The RTSI up 0.02. And the Asian markets see a bit of red here. In the Nikkei in Japan was down 1.31%. Australia up 0.39%. New Zealand again flat. In China, the Shanghai down 0.41%. The Shenzhen Component down 1.37%. China A50 down 0.23%. DJ Shanghai down 0.55%. Hang Seng down 1.27%. And the Taiwan weighted was up an even 1% today. All right. So kind of a mixed day. And I know Chairman Powell was again on the Hill talking to the morons in Washington. And, well, not that, the Federal Reserve is littered with geniuses by any stretch of the imagination. I mean, these are smart people, but I think their own personal biases and their allegiances to certain people keep them doing the wrong thing, in my opinion. All right, let's, excuse me. Move over to the market recap. S&P 500 hits a fresh record as Powell ECB signal rate cuts on the horizon. It doesn't take much for the markets to get excited. Powell says, we're going to lower rates at some point in the future. Everybody goes, oh, great. The market's going to go back up. Let's start pumping cash into the stock market, which, that could be a dangerous game right now. So, a lot of articles I've covered have talked about how the market is overvalued. So, again, be careful. All right. The S&P 500 and NASDAQ surged to record highs led by the tech sector, shocking, as the Federal Reserve Chair Jerome Powell reiterated the possibility of rate cuts this year, fueling investor optimism. Powell's remarks on the second day of his congressional testimony echoed his earlier sentiments, suggesting that the Fed is nearing the confidence threshold required for interest rate reductions. Additionally, signals from the European Central Bank indicating potential rate cuts in June contributed to market enthusiasm. Amidst this backdrop, Kroger's stock soared by 9% after the food retailer issued upbeat annual sales and profit forecasts driven by increased demand for groceries amid ongoing inflation. I'm glad I'm able to help. That's the local store I shop at. Conversely, Victoria's Secret experienced a sharp decline of 31% after projecting weaker annual sales due to sluggish performance in its North American market. I don't shop at Victoria's Secret. I do not look good in lace panties. So, let's see here. Cybersecurity firm OneSpan saw a notable 23% surge in its stock following better than expected quarterly earnings, while American Eagle Outfitters climbed 3% after exceeding Wall Street expectations for the fourth quarter. New York Community Bank Corp continued its rebound, rising 7% after Fitch Ratings affirmed the real estate lender's credit rating following a recent $1 billion cash injection. However, concerns remain about the dilutive impact on the stock sale on common shareholders. Market focus also turned to the monthly jobs report, with the number of Americans filing new claims for unemployment benefits remaining unchanged, indicating a stable labor market. Job openings saw a modest decline in January, accompanied by a slowdown in hiring suggesting a gradual easing of labor market conditions. Investors await the release of the non-farm payrolls report scheduled for tomorrow, Friday, which is expected to provide further insights into the strength of the U.S. economy and potential future monetary policy actions. All right, so everybody's waiting to see what the jobs numbers again look like. See if they're good tomorrow. Maybe that gives Powell he's not going to be talking to Congress tomorrow, but it'll give the people that try to prognosticate where things are headed. I guess they for some reason think lower interest rates are going to be good. All right, next up, a little deeper into the jobs and trade deficit. Weekly jobs claims unchanged. Trade deficit widens in January. The number of Americans filing new claims for unemployment benefits remained unchanged last week, signaling a stable labor market and potentially providing the Federal Reserve with leeway before implementing interest rate cuts this year. Despite a notable widening in the trade deficit in January, driven by increased imports of various goods, including computers and motor vehicles, economic growth for the first quarter is expected to slow only marginally, supported by robust consumer spending backed by a resilient labor market. The claims data indicated that while New York and California saw increases in filings, some states like Massachusetts experienced decreases. The labor market, although gradually loosening, remains relatively strong, with the ratio of job openings to unemployed persons still above pre-pandemic levels. Fed Chair Jerome Powell reiterated the expectation of declining inflation and continued economic growth, but refrained from committing to a specific timeline for rate cuts. Pretty smart there, Jerome. Because if you give these people a specific date, then when it doesn't occur, they're going to freak out and panic, which that's going to happen anyways. Let's see here. Since March of 22, the Fed has raised its policy rate by 525 basis points, or 5.25% for normal people, to the current range of 5.25% to 5.5%. A separate report from Challenger Gray and Christmas, which is a staffing firm, a modest increase in layoffs announced by U.S.-based companies in February, while planned job cuts for the year are down compared to the same period last year. Stocks on Wall Street traded higher, and the dollar weakened against a basket of currencies, and the U.S. Treasury prices exhibited mixed movements. Looking ahead, the upcoming release of seasonal factors and revisions of claims data by the Labor Department could impact market sentiment. However, these revisions will not affect February's employment report, which is expected to show an increase in non-farm payrolls. Economists forecast a stable unemployment rate and a slight slowdown in annual wage growth for the month. Rising worker productivity has contributed to the strength of the labor market, helping to contain costs for businesses. Meanwhile, trade data from the Commerce Department indicated a widening trade deficit in January, potentially posing a drag on GDP growth in the first quarter, although growth estimates remain around 2% at this time. All right, so again, it's kind of good news, bad news, or kind of that medium porridge if you're a Goldilocks person. All right, and some not so good news comes from Zero Hedge. This article is titled "Credit Card Jumps to New All-Time High." Credit card debt jumps to new all-time high as credit card rates rise to new records. All right, the latest consumer credit data for the U.S. contradicts the notion that consumers had curbed their borrowing habits. In January, total consumer credit surged by $19.5 billion, a significant rebound compared to the previous month's relatively stagnant growth. This increase was primarily driven by a resurgence in both credit card and auto loans. Revolving credit, mainly comprised of credit card debt, rose by $8.4 billion, pushing total revolving credit to a record high of $1.327 trillion. That's a lot of debt, folks. On the non-revolving credit side, which includes auto and student loans, there was also an increase of $11 billion, reaching a new record high of $3.712 trillion. The surge in credit card debt is surprising given the record high average interest rates, which reached 21.47%. This indicates that while banks are quick to raise credit card rates, they are reluctant to lower them even amid declining overall interest rates. The decline in personal savings rates dropped to 3.8%, the lowest since 22. Suggests that consumers are increasingly relying on credit rather than savings. However, there are concerns about the sustainability on this trend, especially considering rising delinquency and charge-off rates. And actually, there's a chart down here. Yeah, you can see here the red line is credit card debt, and you can see it dropped during the pandemic with all that stimulus spending and has gone way, 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 way up. And the green line is the savings rate, which it did climb again with all that free money that the government was handing out. Well, it's not free. And then has now dropped below the, kind of the average of, what was that, 16, 17, 18, and 19, was above 5% for the majority of the time, and now is trending in that 3 to 4% range. So not real good. Where was I? Okay. The upcoming election adds another layer of complexity, potentially influencing policies to encourage credit card fueled spending despite underlying economic risks. Overall, while the surge in consumer credit indicates ongoing consumer spending, there are apprehensions about the long-term implications, particularly as economic realities may eventually catch up. And I don't know if anyone out there watches The View. Hopefully anyone who listens to me doesn't listen to those ugly sea hags. But was it Joy Behar was saying that I think based upon the ruling last week that the Supreme Court said that basically you can't do anything to the president, that current President Biden could just put every Republican in jail and also waive everyone's debt. I didn't know that was within the jurisdiction of the Office of the Presidency to just wipe out everybody's debt across the nation. I mean, to me, that just seems silly. But, who's going to pay it? I mean, if you wipe it out, it just goes back to the taxpayer. So anyways, but there's too much debt out there. People are spending way too much or borrowing too much for the things that they need. Probably be best now to sit down and go through your budget, trim the fat where there is some, and, whatever you can get rid of out of your budget, start saving that. That's a genius idea. So, all right. Well, that's everything that I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I shall talk to you next time. Adios.